I'm Keith McCullough, and welcome to another Real Conversation. I'm excited to have this one in person. Alec Pezzoli has been a longstanding user of the Hedgeye process and a friend of the firm, and somebody who's got a completely different perspective, both geographically but also from a professional perspective than most people. And we want to get into big topics like replacing the old Walls 60-40 portfolio, which I think a lot of you care about, and adjacent topics to that. So thanks for doing this in person.
Thank you for inviting me.
Yeah, I guess we'll just start with your background. I mean, because you worked for an American bank and a Swiss bank, right?
Yes, exactly.
Maybe some of the learnings or the lessons that get you to where you are today, because now you're running $4 billion for rich families. You needed to go through the process of learning.
Yeah, exactly. So basically, I'm Italian, so I grew up close to Venice, and then I've been studying, Latin Greek philosophy in the beginning, and then I moved to business. And then when I started working, I entered into wealth management. I never worked one day in Italy, always working around. So 3 years in Monte Carlo, 30 years in Geneva, Switzerland, and then I went to Lugano. And exactly, I've been working for a Swiss bank called BSI, Banca della Svizzera Italiana, so close to my own country, and then for JP Morgan. And after 20 years working for Swiss bank and American bank, I decided it was the time to move on, and so basically set up my own shop, Brightside Capital, and it was 2016. So in February it's going to be 10 years.
That's amazing.
Exactly, where I decided to support families that were going through a liquidity event, so they were selling their business, and they wanted to have one-stop shop to try to understand how to set up their investment activity, their family office, their investment process.
Yeah. How local did you have to go before you went global? Because we're going to go through asset allocation, risk management, the things that one would do with real money, not the things you watch on CNBC, right? It's funny, but it's not. I mean, it's just like, what I mean by that is how local, because you're going one-to-one with each family, in Italy, and you're trying to do a go anywhere global asset allocation.
Exactly. So basically, if you want, origination of the business is local, and the way we think is global. Somehow, Italy is not really a point of reference for finance, right? I think that we can agree on this.
It should be. It's like where the Medici started the whole thing, right?
Exactly. A long time ago, unfortunately. And so basically, origination is in Italy, but the way about investing and thinking should be global. This is also the reason why we're in Switzerland instead of being in Milan, because somehow Switzerland has a totally different story, track record, and so is much more global in terms of thinking and approach to finance. And so I thought that was the best spot to start my own business exactly for this reason.
Does it? How does it? I know every conversation is not typical. There's no general answer to this question, but like how does it go when you go to a rich family that had the 60-40 or the traditional portfolio and explain there's a better way?
Yeah, let's say that normally the trigger is a liquidity event. So normally we start meeting families when they're selling their business, IPO their business, and so we're not even at the 60-40 portfolio. We are, let's say, 100% cash. For sure, in the past they had small investment, and so a lot conservative and a lot on the 60-40. That, by the way, in Europe is 70-30, so 70% bond and 30% of risky asset. But the fact that we are scaling up with the size totally changed the perspective, and this is the reason why we asked for someone new, independent, to act as an advisor. When before, with savings much smaller, they didn't really need an advisor. And so basically, the moment we sat down with people, we start discussing, how we see the world, how we see the market, and starting point for everyone today, I think the North, in terms of thinking about asset allocation, is just one topic, and the topic is there is too much debt around the world. And normally we start conversation exactly on this topic, and I think it's something where it's impossible to disagree. And the second step about presenting the fact that there is too much debt, we move to, so what do we do in a situation where every government is more than 100% of GDP, deficit 3 times the good standard about 2%, because we are 6, 7, 8, 9, 10%. Where do we go? We go to a slogan that a common friend that is Diego Parrilla, normally used to say in this kind of situation that when there is so much debt, normally you default on debt or you default on the currency. So we tend to explain to investors that when there is too much debt, it's impossible to come back really just with savings, but you need to reduce the burden of the debt. And basically you have two ways. The first way is you default on debt. And so, in Europe, you are very familiar with Greece because it happened pretty recently. But the reality is that there are not a lot of politicians that want to do that because it means that next time it will be fairly complicated to be, voted again.
Right.
And so basically 2,000 years of history are telling us that everyone goes for the same formula that you default on the currency. And so what does it mean? It means that when you default on the currency, you try to inflate out of the debt, the real value of the debt, printing money, that is something where everyone today is pretty familiar after the COVID crisis.
I mean, I find it a lot easier to get people who have made a lot of money, either they were given generational money and made compounded returns on top of that, or started from zero. It's a lot easier to talk a human being like that, in particular the capitalists that are the most obviously positioned to understand you, on how you should take everything they've made and start with rule number one, which is don't lose that money.
Yeah.
Okay. I don't think there's one person that I've ever talked to that's ever made a lot of money that doesn't make a lot of sense as a starting point. Whereas we live in an environment where it's just like gamble your money. It's YOLO with your money. I mean, there's a fantasy island over here, and then there's the old wall way over there, and we're in between, not really even in between, so to speak. You might say so because we will buy things that the YOLO crowd buys. But the notion that you shouldn't start with protecting the pile or protecting your hard-earned capital, I mean, have you ever had any pushback on that?
It's impossible. Right?
It's impossible. So it's impossible to debate that, okay, so let's just it's impossible to debate what you said about debt, deficits, preserving and protecting capital as a starting point, right? But on the other hand, I should say, you have a 60-40 portfolio is built 60% of it or 40% of it, depending on who it is, depending on how old you are, depends on trusting that the debt and the deficit isn't a problem on that sovereign credit. It won't create inflation and it won't create the drawdowns you've seen in sovereign debt.
Yep.
I mean, there isn't one, other than the U.S. 10-year bond yield, there isn't one sovereign 10-year yield that isn't signaling up bullish trend. But when a bond yield goes up, the bonds go down. So you got 60 or 40 or 60% of your portfolio is aligned with these ridiculous governments that will not change their behavior.
Yeah, exactly. Warren Buffett used to say that when you invest in cash and bond, somehow, is an investment in the trust of the institution and the governments and in politics, right?
Right.
So in this moment, it's fairly complicated to put, 40% or 60% of your hard-earned capital into something like that.
Yeah. Oh, so I have a solution for you. It wasn't J.P. Morgan, but it's a big American bank. And they said, well, we're going to evolve. We're going to go from 60-40 to 60-20-20. We're going to buy gold now, like at the all-time highs. We're going to do 20% of that. And that's what's going to make us different and special. And you know what? It actually kind of does. Even
yeah.
Can you talk about that?
I think that we appreciate the efforts, right? to try.
I mean, really?
We appreciate the effort to try to think different, right?
How
from
different?
The 60-40, but the reality is that, you're the master on this, that in order to provide quality in terms of thought, you need to have a multi-factor model. And so to simply say, no gold, now yes gold for 20%, okay, fine. Better than nothing, right? It's better than nothing.
You go to the clients that would actually understand this, they already own gold. So it doesn't matter, like what you told them or said to them or what you're new. I mean, here's another question, like going back to, and we'll get off this eventually, but when you go to a new family, like a new family who's got all this money, and you're like, why did you do, like, if they did have if they had 60-40, like, do you get into that conversation of why they would do it? Because I often wonder, like, if you were to stay with 60-40, if you didn't know that you should have been long gold, silver, platinum, you pick any asset allocation decision that we've made, I suggest you're either assuming that your prospective and or existing client is dumb, you're being really slick about it and thinking that they're not dumb, but you can get away with it, that they're not paying attention at all, so they don't know about dumb or slick. What is it? Like, why would somebody do that?
Yeah, so basically our approach is that we totally jump the topic. In the sense, we don't even enter into this is a solution, because for us it's not a solution at all, right? And so we immediately present the way we see things. And so normally entrepreneurs, they are risk taker, right?
Yeah.
So they probably in the past they approach finance simply because they don't understand what's going on and which kind of product they are selling me and this kind of stuff. But in their DNA, there is this thing about risk taking.
Right.
So if you jump on the topic and you provide a model that is accountable, full transparent, and so people understand that we are on the same page and there is full alignment, they also understand that finance is not this black box, and at the end is like taking risk simply in a different industry vis-a-vis where you made your own wealth in the past.
Yeah, okay, right? So you just don't even address ridiculousness.
That's my point. It's so ridiculous that why do we need to spend time?
Man, you could have saved me the last 18 years of my life. I struggle with this. I really struggle with this. The amount of impact that the CNBCs and Bloombergs and everything else have on the world is material. And it's my ongoing daily fight against that old wall to just remind people or at least give them some level of education that what they're doing is dumb, deaf, stupid, whatever you want to think about. But you're saying, when you get to that level, I guess, of wealth, that they're going to get it. They get that should never have even been considered.
That's my point. So you jump the topic and we immediately start discussing, about asset allocation and which is the blend of risky assets that you need to have in order to feel safe.
Yep.
Right? So we don't enter, we really spend, maybe a couple of slides about there is too much debt and about the deficit and about where the bond market is going. We don't show 10 years, but we show 30 years, yield that for sure in all the GA country are all going up. And, immediately people come in line with, our perspective. So it's not really so complicated to push for a different asset allocation that privilege a lot real assets versus nominal assets.
Okay, so let's get into that. Asset allocation or risk management, what comes first? If neither comes first and they go together, I guess that's an answer too.
Yeah, so basically what we tend to propose is asset allocation. And then we tend to discuss how once we decided where we are going to invest, how we are going to do the deployment, and there start, the risk management process.
So do you like profile them, characterize them on conservative versus aggressive, young versus older?
Basically, at the end, not really, because this is, a bulk of money that is going to stay for the next generation.
Yep.
So at the end, more or less, all the families have the same profile. And if everyone gets this point that in order to preserve capital, you need to be much more allocated to real asset, at the end, the profile is more or less the same. As I mentioned, maybe the only thing that is changing is the blend of real assets. There are people that are happy to have listed equity, other people that are happy to have, private equity, other people that enjoy a lot precious metal or, real estate. And so our job is pretty much trying to work around their preferences, around real asset to define the good asset allocation, and then risk management step in. And for us, the first step of risk management is deployment. In average, a client takes 18 months to deploy the capital when they receive the 200 million after the IPO or they sell the business to the private equity. So the first thing that we teach to people is that patience, right? So Rome was not built in a day, right? And so for the same reason, a portfolio cannot build in a day, because exactly everyone is not happy to get drawdown. And when you get such big amount of money, I think that is important also to get a bit of the feeling how you feel about this. You know, when you lose 5% on a 200 million portfolio is 10 million. So you're down maybe one day today, 10 million. So it's a lot, because maybe before 10 million were your total liquid wealth, right? And so there is a lot of psychology into this topic.
It's interesting. That psychology is very similar, even though these are super rich people, to what people miss is that super rich people that aren't liquid people aren't super rich people, right? I'd have a lot more money if I sold Hedgeye, right?
Yeah.
It doesn't matter what I'm worth or whatever. But if you take somebody who has no money and they just start to build their pile, they have the exact same behavioral reaction to losing money.
Exactly.
You know, that's a really important point. So you would, like, because ultimately my question is, would you tell my mom, like, who's a retired teacher, like, would you have any other advice for her to preserve and protect her pile and allocate assets than somebody who's trying to pass on generational wealth?
No, I think that somehow is more or less the same, but the reality is that there is one big point of difference, is that all these people somehow don't need this amount, so somehow they can tolerate a bit more of drawdown and volatility, while if we're talking to someone that, you know, made 200K in their whole life, and, you know, every single $1,000 euro cares, right? And so approach to volatility and risk management should be even more structured, basically for this reason. While with our client, as I mentioned, they are entrepreneurs. They took a lot of risk in their life. They know up and down. Maybe they didn't experience volatility in the financial market, right? But they know about up and downs in revenues, in complexity, in opening a new market, in an emerging market, and this kind of stuff. So we know that it's not a straight line. And so they are a bit more familiar with this. I think that the main role should be to provide transparency to finance. What they find complicated to understand is not about taking risk. Taking risk is part of their life. It's to understanding where are they taking risk. You know, majority of people come there to explain weird products, strange product, things that, you know, are also complicated for people like us that spend their life into asset management. Imagine for people that spend, you know, 5% of their time thinking about financial topics. So this is the big part, and so simplicity, not just patience, is another big part of the process, right? So we try to make things that are simple and easy to understand for client. Why? Simply because the day that there is, I don't know, COVID-2 or Lehman Brothers 2, it's important that you look at your portfolio, understand what's going on, and you feel safe about it. So that's the best way to go to sleep, stay quiet, and hope that from tomorrow the recovery will start.
How do you train I call it training my dragon, or my own inner demons. I mean, how do you train your client, or our Hedgeye Nation, like how the process is going to have their capital behave in certain environments? Use quad 4 as the most obvious example.
Yes.
Because you're going to incur turnover, which is a bad word by the old wall, and the old wall has a process that's bad too, so we understand why they say that, but you've avoided what they say, and you just you have to focus them on that, I assume.
Yeah, so basically we start even before investing. So, you know, remember there was when the bond went up, equity down, bond down, minus 70% everywhere. And so it was a kind of a complicated years for us.
Kind of a complicated situation.
And we understood that we needed to work more on this part about behavioral finance. And so basically we wrote a paper that we call Welcome to the Jungle, that every time we have a new client, so a new subscriber for you, okay, before even starting to invest, you know, 1 penny, we gave them these 10 pages of paper called Welcome to the Jungle, where we say, okay, if we are here, it means that you are deciding to take this thing about investing in a much more serious and professional way.
Oh, good.
And so basically, we're going to provide you these 10 pages to provide all the behavioral finance advices that we think could make sense for you to know before.
Yeah.
Why? Because during this journey, you will feel that you're wrong, that you did wrong, that everything is wrong, that you don't like finance, that Brightside is shit. Okay?
That comes before all the other things. By the way.
Exactly. But maybe you will go back to these 10 pages, look at some things, and maybe you will find comfort.
You should take those 10 pages, put it in ChatGPT, and say, make this a half a page or less, and so that a rich 6th grader can read it. Because then you have a 1-pager.
Yes,
and
that's true.
Because 10 pages is a lot. I mean, but 10 pages, thank God you have it, because most people in America or in Switzerland or otherwise, they don't train their dragon. They don't have a note called Welcome to the Jungle. Yeah. They don't talk about quad 4. I mean, there's no preparing your client for, it's like preparing a child, a rich one in this case, you know, for not preparing them for rain.
Yeah.
Like we should just dress the same.
Yeah. You know, we need to prepare for a lot of things. We need to prepare to understand what does it mean, for example, stay invested. You know, a lot of people have this crazy idea that you can go 100% cash 1 second, and then we show them that the reality is that when there are big drawdowns, very close to the big drawdowns, you have also very strong days up.
Yep.
And you know, statistics are saying that if you lose, you know, the best 20 days in the S&P, your 10 years performance is going to be half on what it will be if you stay invested, right? So there are a lot of things that people normally don't.
Well,
don't grasp.
that statistic, they should have disclaimers on it. Maybe you get RFK or somebody in America on this thing, just making. I don't even know if you can call it making asset allocation great again, because it never was great.
Yeah.
I mean, you don't. There should be disclosures for America, for everyone, on how this actually works. Like you shouldn't have to like say what you just said, and that be a unique thought. Like, to just, how many people out there have been told what their actual return would be if you took out those 20 days? I mean, David Salem will roll that, and maybe that's where, I mean, I've seen it written initially or in the past, but I probably spent 20 years in my career without even knowing that. I know it intuitively, because if you miss being positioned for quad 4, that's pretty much the end of it.
Yes, exactly.
But I mean, like the return, if you miss those stats we've shown as well, if you've missed the last 3 quad 4 U.S. stock market crashes, if you've avoided them, your 401k would be double what it was prior. Could be triple. If you go all the way back to 2008 and avoided every quad 4, I think it might be actually quadruple. But whatever, it's a lot, right? But do you think CNBC is going to start the morning with that? No. Do you think Morgan Stanley is going to start the morning with that? No, but they should.
No, yes, the reality is that one thing is you need to sell something, and another thing is that we are on the same page and we need to go through this mess all together.
Yeah, you need to keep paying me while we go through this together.
Exactly. So I think that this is the big difference. The majority of people, you know, they're just trying to sell something, and so they get their commission, but there is no alignment. And this is the big problem, why people like you and people like us, at the end we are on the same page with our client base, and so we need to go through this journey together.
Yep.
And for this reason, what is crucial is to educate.
Mm-hmm.
When you're selling something, do you really want your client or potential client to be educated to understand what's going on there, to understand how much is the cost, which is exactly the strategy, this kind of stuff? No, you don't want. You just want, you know, maybe, you know, they're paying in a bigger incentive, you sell this specific product and this kind of stuff. So I think that is really everything is related to this thing about conflict and alignment of interest vis-a-vis client. When your model is aligned, everything looks much more easier, and education is paramount.
Yeah,
and
conflict of interest. I mean, if you're to summarize it with just one, you know, it's conflict of interest, and always pay attention to how other people get paid.
Exactly.
I mean, that's it. It's, in our case, we're trying to preserve and protect our pile and compound what we've been paid historically, which I think, I mean, there isn't a human being who's looked me in the eye and said, no, that's not really. Now, you might get a bunch of questions, right? Like, instead of talking about the solution, it's like our culture. Whining, complaining, excuses. Well, what about the taxes? What about the turnover? What about all these talking points? It's like, no. What about losing 20% of your capital when everybody else does? That decision will eradicate anything you can ask me.
Yeah, and there is also, you know, a funny question normally I tell to my client, you know, when there is someone that is coming to push for a product, I say, before deciding what to do, the product is nice, this kind of stuff, please ask this guy to show his asset allocation, how he's invested, what he has in his own portfolio, which kind of performance he's making, and then we start talking about the product. Yeah. You know, it's too easy to say, you know, this emerging market fund is great, no, we need to put 3%. Where are you invested, right?
Yeah.
So let's spend a few minutes discussing about this, then I will realize if we really need you as an advisor first.
So let's do that. Let's like, we can either do pretend, or you can do it with like a real one. Let's take $100 million and let's start today. So we want to have, and again, I don't want to, you know, go back and disrespect or ignore what you said about having patience, because that's a real important point. But for the sake of this exercise, let's just do, we got to be fully invested today, right? But you really don't have to be.
Yeah.
You know, like if I sold Hedgeye and I had a pile, I wouldn't go, okay, JP Morgan, make me fully invested tomorrow. Only JP Morgan would want that with fees, right? So $100 million bucks, we start today. We're at the top, top of U.S. equity beta moves. We're coming off the top in European equity moves.
Yeah.
Which, from our perspective, of course, we think that's much more interesting because we think that's the beginning of a legitimate drawdown and or decline. We have bond markets. We have gold at all-time highs, et cetera, et cetera. Like, how would we start if I came in with $100 million bucks? My primary goal is don't lose my money.
Yeah.
And let's find a way to capitalize on. Let's only use the next 6 to 9 months of the quads.
Yeah. So basically, what we discuss is an asset allocation. And so we define an asset allocation. Maybe I can enter quickly on how we see portfolio.
Yep.
And so what we tell to client, we don't present portfolio in the traditional way like cash, bond, equity, flexible fund, whatever it is. But we have this sport team formula that I hope you will like, that is offense and defense. So basically our portfolio becomes 60-40, where 60 is offense, so we try to compound return, and where 40 is defense. On the 60, that is...
so it's not 60-40 stocks bonds, it's 60-40 stylistically on offense.
Exactly.
40%
with
assets
5% of bonds.
Play defense.
Exactly, with, let's say, 5% of bond max.
Oh, wow.
Okay. So basically, on the 60% is a blend of long-only equity and hedge fund that can have, implicit protection. But this part is to compound return.
Like outside managers?
Yes, exactly.
Okay.
And here, there is nothing specific. I think that the big difference is about the difference. And so when we go to investor, we say that we need to protect from two things. First topic, drawdown, another COVID, minus 40% and this kind of stuff. Yeah. And the second risk is the one we mentioned before, is that too much debt, so money losing value. And money losing value for us is the basement, right? And so what we tell to people is that we need to protect from both. And so you need to have different buckets of the portfolio that help and support in case there is a drawdown or in case money is losing value. And so on the part for the drawdown, what do we have? We have 70 points that are basically invested in a blend of managers, so no, not ETF, but active manager, that somehow they are long anti-bubble strategies. In the sense they are long strategy that should perform well when there is a quad 4. So we have managers that are trading the VIX, okay? We have managers that are short credit spread, okay, that should expand when there is a crisis. We have managers that are long option on gold, for example. We have managers that are long bias on volatility, but they play the dispersion.
So this is in your defense bucket?
Exactly, to protect from the drawdown.
But it's really like having a goalie who gets a lot of shutouts right now because your defense is your offense.
Yeah, but which is the difference? The reality is that you're buying insurance, right? So when the market is going up, okay, you're paying something, but the reality is that this allows you to be much more aggressive on the offense. Why? Because normally in the traditional scheme that we have, for European client, you normally hold just 30% of risky assets, while here we are at 60. So you can be much more aggressive and so compound much more stronger. And the cost of this, yes, is an insurance. Like you have an insurance for the car, you have an insurance for the house, but no one is complaining because we are paying something for the car and the house. And so the logic is more or less the same. Then, if we are good, or if we are lucky, or the managers are good, we're also happy to control pretty much the cost, in the sense that, for example, if we overweight a manager that is long option on gold, we risk, for example, in years like this year or last year, not to pay anything for the insurance because the manager that is long option on the gold is performing big time positive and so can contribute to bring to zero the cost of the protection. And then we have a bit of gold also on top of the 70 points of volatility or anti-bubble strategies. And this is to protect from the drawdown.
70 points, what do you mean by 70 points?
70% of the portfolio is done with these kind of strategies. And gold stands more or less at 5, and then we have a couple of points of treasuries, and this is the defense bucket to protect from the drawdown.
Now, so what would happen if when we phase, because that works awesome and has worked awesome this year, because of course you go quad 4, epic drawdown, February to April, vertical bounce like we've never seen actually in modern markets other than coming out of COVID, really. And so how do you get to the next part of the movie? Because all that stuff works, if bond yields in the U.S. start to break out and the dollar starts going up, gold could start to go down.
I think that we have a kind of a slightly longer time horizon, in the sense that you normally look 1 month, 3 months. We tend to look a bit longer. So how we tend to look, it's 5 years time horizon. And for us, it's not really where the market is standing, but is in relative term. So what is a 70-30 portfolio doing since 2020 with 70% of bond and 30% of risky assets? Okay, and so we see there is a big difference. I can give you one number, but and is about this thing about real assets versus nominal asset. That is the one that we tell all the clients all the time, and is from 2020, the difference of performance between gold and TLT, so long-term treasury, is more than 120 points of performance in 5 years. That will be almost impossible to catch for any kind of bond investor in the next 30 years, maybe. So this is how we see things. So tactic for us is a bit less important. We tend to move around the quads. We need to have tactical overweight on the offense part. That can be industry, can be geography, this kind of stuff. But the reality is that for the big negative movement, we have much bigger protection than no one has, because we have 17 points of managers and strategy where we are invested that normally should protect exactly if something goes a bit, comes shaky again.
Yeah, when you vet these managers, like what is the success rate of these managers passing your due diligence test?
Okay, I don't have a number, but obviously like everyone that is doing, manager selection is super picky. So we have 7 managers where we're invested, but I don't know how many managers the team is looking all around the world in a lot of different strategy. And this thing about being selective, I think, is a must somehow in finance, because if every time someone is knocking on your door and say, I have a great product, please come in, 1 million is going to be
it's
a disaster,
one of the biggest
right?
things I hear from clients and prospective clients. I got lied to. I got promised this return. I got invested with the mooch or something like this. It's like, that's a major problem, right? It's constantly being marketed. You should be with this super flavor of chocolate ice cream. This manager is the best hedge fund manager nothing you've ever. Trump couldn't market the thing better, right? I mean, and then the guy sucks. Yeah,
I think that as you mentioned, education is paramount. So as I was watching before the macro show, and so the point where you said that when someone is coming to you and say that I promise, right? Yeah. Please leave the room, right? Somehow, and so it's important to tell people how things stand in reality. Yeah. And we know that everyone that is trying to sell something, is playing a lot with psychology of people. And so everyone to have, a granted return, just upside, no downside, and this kind of stuff. But this doesn't belong to life, doesn't belong to reality. So I'm sorry to break your dream, but simply doesn't exist.
No, you say, "Welcome to the jungle. Here's my paper."
Exactly.
No, but it is. I say this quite a bit as well because it's true. I try to keep it truthful, which is. We as human beings seek certainty. It's a natural instinct, especially when it comes to like our family and our firms. And you think about your hard-earned capital. I mean, people want the answer to the question to be the one that Wall Street has given them. Yeah. They want it to be high conviction. They want it to be certainty. And it's a lie. Yeah. I mean, people want to be lied to, essentially.
So instead of promising people, what we tend to teach is about the value of convexity. Yeah. So short-term pain.
You could lose a lot of people pretty quick with that one.
Yeah. For the moment,
And you said it with an Italian accent.
Yeah, exactly. So, but at the end, nothing that is important can come in a different way. Short-term pain for long-term gain, right? And so we try to explain to people which is the value of this. You train a lot today to be able to sustain your life and be fit when you will be 70. Yeah. You study a lot at the university to get a degree, to go to work, and have a very nice career. So everything passed through this, and is impossible to avoid if you want to reach something in your life. So again, if we need to break another dream that you get important things easy, we are there to break this dream.
Yeah, I mean, how easy is it to get a client against the old wall. It's like, what are they saying? Like, I mean, it's just, you can't believe it that it's still an opportunity. Like, I mean, just the inability for the richest and most profitable industry in American history, I think that's safe to say, Wall Street, to not have to evolve alongside things that they love. AI, which has embedded fractal math, you know, the whole concept of flexibility and creativity, diversification. Like, for them to not evolve a thing since you've been doing this, or I for that matter, and you've been doing it a little longer than me, it's incredible. I think it's this perverse blessing.
Yeah, but probably, you know, it's a human being in the sense that not everyone has the driver that you have in terms of growing every day better, this kind of stuff. Probably, you know, humanity has a probability distribution that, you know, majority is simply happy to stay where they are. They don't want to evolve. And maybe on the right tail, right?
Yeah,
you have some people that are happy to wake up every morning, build something, you know, adapt and continue to grow.
I think I think the happy part is one of the most important words you use. I think they're happy because they're still getting paid. If you took away their compensation structure and all their schemes embedded therein, they would wake up not happy. And then they'd have to get creative and join firms like yours. And or just go to the next place that's doing it in a better way. You know, I think it's because we keep getting them paid. It doesn't make any sense for all the market cap in the world to be disrupted to the downside because of AI and ripping to the upside because of AI plays on real estate, everything other than asset management.
That's correct.
We can't. We're happy. We don't want it. We don't need to change. It's because they're getting paid.
Yeah, but you know, somehow this is where the opportunities stand, right?
Right.
So we're happy to have someone that continue to stay complacent, not changing, conservative, and you know, so we hope that this can continue for several years, even if, you know, as you said, technology for sure is going to bring a stop to all this, and somehow pretty soon.
Do you think your solution, which has been very successful, I mean, do you think that your solution for really rich people, I used $100 million as the example because that's a lot. It's more than most people have, you know. But do you think that your solution can apply to my mom or can apply to somebody who's going to be worth $10 million, but they're at one?
We definitely think simply because of this macro framework. And today, if you have 1 million, if you have 10 million, if you have 100 million, you know, the problem is always the same. You know, nominal assets are not the way to preserve your wealth and your capital. And so this is a problem that belongs to, you know, billionaires, like belong to people that have, you know, small amount of savings. And so there is, I think, a big space to try to democratize this kind of concept and explain to people that things need to be done in totally different way. We know how complicated it is, you know, to change your own way about saying things. We did this the last 20 years, always the same way, and so we need to continue. But you know, there are certain moments, there are kind of a Minsky moment where you really need to invert the trend and try to innovate, make something different to preserve your wealth and mainly preserve your family, right? Because at the end, the wealth is there to try to support the effort of the next generation, no matter if you have 100 billion and, you know, or 100K.
I will be shocked if we've not already crossed the Rubicon on this, on active management. You know, Bogle's big contribution was because they're lying to you, because X percent, a very small percentage of people can actually do what they said they do, which is generate alpha or beat the market. We're just going to drop our fees. That was the best sales pitch in the history of Wall Street, according to me. I mean, because it was true. He had lower fees for a passive index return, and then it manifested across all different kinds of products. He fought the ETF introduction, and eventually Vanguard went there. But we're starting from a very different place, which is most people should start with that assumption. 80% of people are lying to me or can't perform over time. But I'd like to have some insurance, not just low fees. Right? You said your car. I mean, what is your car worth relative to what you've worked for your whole life? What is your house worth? Those should dwarf what your action. in some cases, if you have a really nice house, let's be clear. If you have a house in Lugano, some of these places, I get it. But you should start with risk management and insurance. I mean, to me, that like we've crossed the Rubicon. It's there. Everybody can see it now. Did it take like quad language or like something in risk management to get some lights to go on with you guys too? Because there has to be a trigger, right? It's one thing to say risk management. It's another thing to accurately and timely manage risk.
Yeah, I think that if we consider asset allocation level, okay, this thing having, somehow protection, so a part of the portfolio that should perform positively in case of a crisis is already risk management by definition.
Right.
Exactly. Then we have a second layer of risk management.
Risk management, like I'd like to think of that as like risk management by execution.
Yeah.
It's like as a matter of process, we're managing risk.
Yeah.
As a matter of process, it's raining today, we're selling some. As a matter of process, it's sunny tomorrow, we're not wearing a raincoat.
Yeah. Then the second part is about the tactical move, right? Where
the shift.
Yeah, the shift, the quads. So what you guys are doing, how we rebalance portfolio, and so somehow there is a structural part that is a kind of thinking all weather, in the sense that you prepare something that should be good in all the seasons somehow, and then you have a second layer of risk management where you adjust, depending on on the season, the quad, and
as soon as you say that, like some people are going to start to say, like some people say that like I copied Ray Dalio. I mean, because he uses all weather model. I mean, if you look at our returns and what we've gotten right and what he's gotten wrong in the last 10 years, it's not even remotely close. And I'm not saying that arrogantly. I'm just saying that that's an empirical fact.
Yeah.
But when you start to think about this different environmental map, a lot of people understand that. Like a lot of our clients have been very successful running family offices where they take outside money, RAs. They're like, think of one in particular in Pittsburgh that we're really close with. DB Root. They wouldn't mention it. They actually probably maybe a little marketing for David Root and the team. But they talk about the Four Seasons. I mean, this is like a really powerful way because it ties you to what markets actually are versus what you're taught in school. Markets are like a natural ecosystem. There's nonlinearity. The predictability is very low. People get that. I sense that that's one that is, if we're talking about the Rubicon having been crossed to risk management and insurance being things that you would prefer to have, to me that's probably the simplest schematic you can use.
Yeah, for sure. And we're going exactly the same in this direction.
Right.
And so we continue to stress more and more about implementing the two different layer of risk management, obviously, but already everything is a relative game.
Right.
So already our setup vis-a-vis anything that we see, from all the major institutions, is much more stronger in terms of, process in how we manage risk, and also because we have this into the DNA. I'm not sure that all the others, as you mentioned before, are waking up and thinking about this.
No, that's the
every
most
morning,
important
right?
thing. Are the people who run the place, is their North Star understanding the cycle, the full investing cycle, understanding the four quads. That just to start, why people don't do it that way yet, that they have to start with that. You have to wake up, it has to be part of what you do. Like if you say, okay, so we're, just think of the four quads. Currently we're long small, mid cap, risk. That's what you should do when you have a 3, 2, 1 quad count. You know this. Most people in Hedgeye Nation know this. That means the economy is going to improve sequentially from the third quarter to the coming quarter and the one after that. That means that you can take on more risk, just like in 2021, 2020 and 2021. But then comes 2022, and Hedgeye is saying we're going to have a worldwide recession. Quad 4 is going to hit across the globe. It's going to be probably more obvious as a recession in Europe because they've been spending there the whole time, and now the USA is going to mask it with even incremental European type spending. So you can have a non-reported recession, but it's really a rolling recession inside the economy. Whatever. The market crashes. If 2026, for me, 2026 should be 2021. If I just use small caps, let's just use something that's going. How do you deal with that's going to be in your offense bucket, right? So would you just take small mid-cap equity exposure out and or take European equity exposure out and replace it with staples, utility? Is that?
Yeah, something like that, exactly. That's the idea. So on the short term, we follow a lot what you guys are doing.
Right.
You know, so you know probably better than me what that will be good to do in a situation like this.
Yep.
But we keep somehow a core allocation, to the indexes.
Yep.
So the world, for example, and then we try to work on the satellite to exactly with this kind of theme to reduce a bit, the risk of drawdown. Then on top of this, we have hedge fund that we have somehow a good degree of implicit protection in the sense that they can also go short, and so they can also provide protection. And then we have, anti-bubble managers, and then we have gold. So we have plenty of option to protect capital and to reduce drawdown when times are coming in quote 4 fashion.
That's great.
Right.
I people say you can't talk about everyone's performance. I'm like, whatever. I mean, people are doing whatever they're going to do. I mean, for me to say, if you look at a prototypical like Hedgeye power user, from Dave Root in Pittsburgh to you in Europe, what you can find is one very common thing. I'd say almost 100% consistency, which is during Quad 4, their return profile versus everyone else's. And that's it. I mean, it's more obvious when you get a 2008, a 2022, or 2020 really for half the year, but that was a very unique moment, obviously, in time. But a 2022, like a proper from cycle peak economic slowdown, it's just blazingly obvious how much better people have done.
Yeah,
right.
Definitely.
So is that something that your clients, because you started Brightside in 2016, right?
Yes, so we passed through different crises. Yes, they saw a lot, and exactly we tend to make the difference during the drawdown.
During the drawdown?
Yeah, this is the main point. Just think about the idea to have a limited amount of bond during 2021, right? That were down even more than equity.
Yeah.
Made a big difference in terms of how you preserve your capital.
Well, this is people are going to screw this up again, man. I mean, it's people are addicted to Fed cuts. This is going to be on and on and on. Pump's going to fire Powell, and we're going to have more and more rate cuts. But if you have more of what Quad 2 actually is, which is dollar up, bond yields up, you could still have stocks up. That's what Quad 2 did in 2021. But you went back to back. My mom started calling me in 2021. Why? Because she's in the 60-40 with this fixed income problem, right? My mom hasn't called me about her retirement account ever, right? And then you go body bag to body bag. You go from fixed income body bag in 2021 to equity body bag in 2020 and Bitcoin body bag. You got a lot of body bags in that 2022. I hate to stop reminding people of that because the old wall will never talk about their losses. They'll only talk about their wins.
Yes, and this is the situation, and but this is the reason why I think that business like yours, with so much focus on education, really making the difference and providing great value for subscriber and investor, and more or less the same logic applying to us, right? People see that there is a big difference. We understand alignment. For us also something that is very important is that I think that an entrepreneur wants to talk to another entrepreneur. When they come at Brightside, they realize that he's someone that took risk with his life, his family, his savings, his career, and he's not there simply to sell, the new product about ESG or whatever it is, right?
ESG. Well, we're laughing, but that's what the old wall does. I mean, can you think of a more miserable life than selling the old wall's bullshit? I mean, but people will do it because they make money doing it. And for some people, happiness, unfortunately, is money. Right, so I'm just happy preserving and protecting the pile. I mean, that's a real big one. Just to switch topics before we, because we have about 10 minutes left here. I'm actually wearing a Ryder Cup. So I'm trying. I'm not Republican. I'm not a Democrat. I'm Canadian. I'm not going to say that I'm cheering for the Europeans, certainly on this broadcast, or the Americans. This is the 2027. This is going to be at Adair, which is in Ireland. Of course, that's the next one. But we have to go through the heat. Yeah. And you're in the area. We're going to have. I think it's coming up this coming week. All right. So, how are? We're not going to talk about golf, but how are Europeans with money feeling about Americans and or the President of the United States?
I think that Europe was in shock for the last 9 months, since Trump started. And the reason I think is very simple, because he made much more explicit
Yeah.
that US is ruling Europe. I think that before Trump, US was ruling Europe. I think for people like me, it was pretty clear after, I will tell you why, but it was less explicit.
You
so it
didn't
looked
say
like,
they were doing it, but they weren't saying it.
no, it looked like every politician could do something, and then there is ECB that could do something, but the reality is that US ruling Europe, and the reason is very simple. I had one client that is an Italian guy that made his career in the US, that was helping the US government after World War II, taking care about the logistic when they're opening military base in the EMEA region, so Europe, Middle East, and Africa.
Interesting.
And so when we were having conversation about exactly Europe and US and two different culture and what's going on in Europe and US, it was always going back to the same point. That is the following. Say, Alex, in Germany there are 35,000 US soldier there, and I don't know how many bases. Who do you think that is ruling Germany? The Germans or the American? I think he's pretty straight. What would you say if in US you will have, 20 base and 100,000 Chinese soldier? Who do you think that is ruling US? The Chinese, or the US government?
It's a very good point.
And so this is the reality. Europe lost World War II,
Yeah.
and so we're still there paying the price for this. And this is the reality. So the relationship is, I would say, fairly complicated, especially in this moment, because somehow US help a lot Europe. And today is a moment where, because of the deficit and all this kind of stuff, US is asking something back, right? And so this is why we get to the 50% tariff. This is why we get to, mandatory investment into defense, into technology, buying energy not so cheap like you buy from Russia and this kind of stuff. And so maybe the way Trump present this, is not so calm and so can create, excitement in Europe, but this is the reality. US is saying, well, we helped you for 50 years, now is your time to help us. And this is somehow is complicated to think for people that always have been thinking that, Europe is autonomous, we are doing what we think is good for the continent and this kind of stuff. So I think that we are at this specific turning point. But for us it's fairly simple, and like it's very simple to understand what's going on in the market. As you mentioned this morning on the macro show, this year was a strange year because Europe was outperforming US.
Yes. By a lot.
Exactly. First 3 months of the year, right? And so everyone was super excited, and finally everyone is understanding that US is not the place to put your capital, and now everyone will bring his money back to Europe, and you will see. But the reality was, short term, and 3 months, and then you show the statistics that from April basically every day the overperformance is reducing, and it will continue to do that. So. This is where we stand, and that's it, I would say.
I'm waiting for some of my Canadian friends to come to this realization as well, because some of your answer was qualitative in your own experience, obviously, but it's just, if you look at the consensus, it's just a fact, right? So if you have, like, when the US policy is this to both Canada and Europe, Canadians and Europeans start to feel something different. It is about the feels.
Yeah.
Right. So
it's never about the fields, right?
Yeah, exactly. If you go to Canada, you can go anywhere in Canada, and they're like, no, like we're not going to roll over, but eventually you might, and they don't like that idea either, right? So it's just this interesting time in markets where you can have a go anywhere strategy, but we have clients all over the world, right? But what I find to be a pretty interesting divergence is this kind of like uniquely American bubble too on the other side.
Yeah.
Which is they don't typically, you have a Canadian having a conversation with an Italian, and both, love America and everything that, all the opportunity that's born out of it. But we're at the same time empathizing with our countrymen, that is just saying that you're being told that you're that big and you might even be smaller. Right?
That's the reality.
It's just like, is that even part of the discussion when you're bringing on, like, there is a political dynamic to that, where you're bringing on a rich European family?
I think that is a multi-factor model, and so somehow it's a complex model, and for people to be able to understand the complexity is always very difficult, right? So because here we're discussing about the economy, we're discussing about business, we're discussing about politics, we're discussing about geopolitics, about FX altogether, right? And so it's complicated for people to understand, while I think that in this moment we are people that are in finance like us with this multi-factor approach are an edge in understanding what's going on. For example, what I think is very important for this moment in the US, that it looks like we have a great macro investor at the Treasury, right?
Yes.
So I think it's really important in this moment to have a macro investor, and we see the move on the dollar, for example, in this first part of the year, and no one is really understanding this. But the reality is that everyone in Europe say, okay, we're done. Okay, now, it's over 17, 18, max 120, and then we are done. But the reality is that we don't know, because if US is ruling, also Europe, and if we have a great macro investor, maybe to full growth again, maybe next year we're going to have another 15%. It's not going to be the first time. I think is 2011 we had this BTP crisis in Italy with BTP 8%, and a couple of years before we had euro dollar 140 and Italy in recession for 8, 10 trimester in a row.
Yeah, I mean he gets it. Scott Bessent totally gets it.
Yeah.
Former Hedgeye client, full disclosure. The problem, if I think about the quad outlook, the better we do throughout this quad 3-2-1 count into the midterms is as overconfident as any human being, including Scott Bessent and his boss, will be. So there's a really interesting setup where the end of the world that a lot of people have been positioned for, if they're anti-American, for example, because they don't like this being thrown at them all the time from a European or Canadian or whatever, Portuguese, like you think of all the different places where people, Brazilian was going to say, perspective, you could end up very much, the high probability event is that the US bubble is real and that US power is real in this shorter term moment of economic history, because another 9 months isn't that long.
Yeah.
Where you could be setting up for this really, really bad geopolitical environment with markets going down across the board. It's something that I don't talk a lot about because I'm not positioning for that yet, but that's the way the quads work. And that's the way human beings work. Because if the quads are good, they're confident, and if they're bad, they start wars, right? And they start, all the different kinds of things you see when a country enters a quad 4. Europe's going to enter the quad 4 before that, which will make it all the much more problematic. Quad 3 stagflation, or actually we have quad 3 stagflation, I shouldn't say quad 4, but eventually they could end up back in quad 4.
I think there is a US analyst called Hugh Groman that maybe you're familiar with what he's doing, and that is doing independent research and something that I think is remarkable. And one of his points about what is going to happen, he mentioned the fact that tax revenues in US are pretty much dependent on capital gain on the stock exchange. So today US is running a 7% deficit, but in case we have 12 months, 18 months of stock exchange down, you risk to have 3-4 point of additional deficit that could bring deficit double digit in a moment where there is such a stock of that can be really problematic. So I think that into all the different equations, I think it's also important to remember that there is also this part that contributes somehow to provide stability to the US tax revenues.
Yeah. I mean, I'm safer as opposed to having a longer term narrative, which I spend zero time reading.
Yeah.
It's fascinating. I could read science fiction too, but I don't. It's a lot more profitable when your goal is to not lose money and then compound returns, to stay with the process, and have every question about a narrative start with those numbers.
Yeah.
Right. If this quad outlook plays out, then that could be the spot. Not this is the way the world's going to be, therefore this is how I should be positioned. Two completely different processes, right? And that's why you're successful with this, because I think most human beings, whether they've been in markets or not, I think they understand the common sense of it all. So.
No, at the end, everything starts from the numbers, everything starts from the data, and this is where we need to buy the foundation of, our processes, our asset allocation, and somehow also our businesses.
Yeah. Well, thank you for opening up to a real
Thank you for inviting me.
And I know a lot of people have a completely different perspective now. Please don't cancel the Europeans and the Canadians, or who you think is going to win because of who you think is going to win the Ryder Cup. But again, what we're trying to do is again explore the process, how people are deploying real capital within the process, and again just trying to show you that it's a much better way.